Thank you, Dick. Last year at this time, I decided to talk about what was going to happen over the next year or so in the economy, and I know all of you remember that talk. It was memorable. And the thing that I emphasized at that time was that understanding where we were going to go and how fast we were going to get there meant understanding when the housing market and housing real estate prices were going to bottom out. At that time, I gave a prediction of about 35 to 40% decline in housing prices nationwide. What I'd like to do tonight is to sort of continue that and talk a little bit about what we know from looking at past episodes exactly like this one, about how long a recession like this lasts, what to look for, what to think about as it goes forward. In the post-World War II period, there have been 18 bank or financially led recessions that have occurred. 5 of those are what we call the Big Five, ones that have been very large, of about the size that we have right now. This would be added to that, making it the Big Six. The last very large financial market collapse happened in Japan in the early 1990s, and it took a long time to recover there. But I think there are some surprisingly similar features across all of the Big Five collapses that have happened since the post-war period. In each one of these, there's been a very large run-up in either commercial or real estate prices, housing prices prior to the collapse. Remarkably similar amounts of increase in the United States, 35, 40, sometimes 50% increases. That's very standard across all of these large financial market collapses, the Big Five. Once that happens, it takes about 3 years, 3.5 years on average, for real estate to work itself out of the decline and for prices to stabilize. That would indicate that we have about another year where housing is going to be kind of soft. Housing prices peaked in July of 2006, so you can do the math. We would expect housing prices to bottom out sometime in 2010 if the past is a good predictor of what's going to happen to us. Another thing that is very similar across past financial market collapses is the decline in the stock market. Typically, stock market declines are on the order of 50% or so. U.S. stock market declines are roughly in that range. Typically, stock markets, as you know, come back before real markets, employment markets come back, but it usually takes 2 to 3 years, sometimes longer, as long as, in the case of Japan, 7 or 8 years, before the stock market really recovered back to its pre-collapse stage. And that looks probably like what we're going to be going through. We've had a good run-up in stocks, but we're far, far away from really the peak. And so over the next couple of years, if the past is prologue, we should see the market climbing back up, but not real fast. Another thing that one sees in looking at past collapses, and again, this is remarkably similar across all of them, is a gigantic increase in outstanding government debt. That is, borrowings by the central government. And of course, that bothers a lot of people now. It's a hot button issue. The United States government is issuing public debt at the rate of around $700 to $800 billion this year, far and away larger than any other deficit that we've run, and probably will do the same next year. So our public debt will be rising. Typically, you can see a run-up, almost a doubling of public debt during these particular episodes, and that looks like what's going to happen. I think the most sobering thing, though, and I'm saving this for last because it is sobering, is that when you look at the unemployment dynamics after a financial market collapse, they don't look really good. Typically, unemployment from lowest unemployment to highest unemployment, that is the trough part, goes up about 7 percentage points. That would mean we started at around 5%. We're probably going to peak probably in the 11, could be 12%. And I think generally forecasts are coming in at 11 or 12% where we may peak. So it looks like we're pretty much on target there. The other thing is the dynamics of recovery in the employment market are going to be slow. That is, looking out over the next 2 or 3 years, it may be that unemployment slides down below 10%, but probably not for a couple of years. That's because real estate markets, by their very nature, their real assets, take a long time to adjust. Stocks of housing have to be worn out, and the new housing construction has to be very low, which it is, in order to bring supply and demand back into balance. Those of you who follow what's going on contemporaneously know that last month very bad housing news came out. Housing starts were far below what were forecast. Housing sales dropped. I think that the fact that housing starts fell so much is in fact a sign that the U.S. economy is starting to bring its housing market rapidly into equilibrium. The fewer housing starts you have, the smaller the housing stock, and we have a huge housing stock overbuild right now. And so I would not interpret that in really a tremendously negative way, although, of course, it contributes to the unemployment that's occurring. I think that's an outlook over the next couple of 3 years, and I think that what I did was not really do this statistically, but heuristically, kind of giving you what we know just from looking at history, just from comparing like episodes, and so I think it's fairly informative in that regard.